If you've watched any of my videos on this channel or followed it for any amount of time, you'll know that I believe term life insurance is one of the best products for the majority of Canadians. However, term life insurance does have some limitations. There are some good things and great things about it, but there are some bad and ugly things about it. And in today's video, I'm going to go over the pros, the cons, the good, the bad, and the ugly of term life insurance. And by the end of it, you'll know exactly if it is the right product for you. What is up, guys? For those of you new to the channel, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we help thousands of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. If that sounds interesting, I'll put a link in the description. You can check it out. But without further ado, let's just get right into this video. So term life insurance is one of the easiest types of life insurance to explain. Permanent can be quite complicated. Term is very simple. The easiest way that I explain it is it's like renting a house. As long as you pay your rent, you get the benefit. As soon as you stop paying your rent, you're going to get evicted and kicked out of the house. The same is like term insurance. It's very similar to term insurance, where you have your premium and you can pick a different premium period or a term. There's term 10, there's term 20, term 30, term to age 65, term to age 100. And as long as you're paying those premiums, you get the benefit. Now, at the end of the term, one of three things, I suppose, happens. Number one, you either cancel your policy. You don't need it anymore. Your investments are doing great. Your mortgage is paid off. The kids are out of the house. For whatever reason, you don't need it anymore. You cancel your policy and go on your way. Number two, you can either renew that policy with that existing provider, and this is regardless of what health conditions you have. Most carriers in Canada will have this feature, although some of them don't. So you can renew it for another term. So if you pick term 10, it would be another 10 years. If you pick term 20, it would be another 20 years. Or if you were still healthy and could go out onto the market, you would then just go out onto the market and get a separate or different, policy at an affordable rate, whatever the market rate is at that time. And the third option is maybe you don't need to renew it for another term or get another term policy. Maybe you're a little bit older now and you're thinking, hey, maybe I should get some permanent life insurance at this point. The third option is you can convert it. Again, assuming that the carrier you chose has this convertibility feature. Again, most companies in Canada have this feature. One thing to note though, you can only convert it with that carrier. So what I mean, for example, is if you have an RBC term life insurance product, that means you can only convert it to an RBC permanent life insurance product. You can't go from RBC to BMO or, IA to Equitable or whatever it is. You have to stay within their ecosystem. Now, the reason you would pick this convertibility option, you're still going to have the coverage at that current age. So if you converted it at age 55, it would still be the same price if you went out onto the market and tried to get it at age 55. The main difference is they have to allow you to convert it regardless of your health. So let's say you had some type of health condition that came up. Maybe you had cancer for some reason. Maybe you had a stroke. Maybe you had diabetes, or something came up that would prevent you from getting affordable rates on the market. Well, you can convert it with them at standard rates within their ecosystem. Now, the reason that this is such a popular choice for so many Canadians and Americans, but we're talking about Canada here, is the fact that it's very affordable. The premiums are incredibly low. It's very affordable, and it is just meant to protect us for a very specific period of time. So, we have children, we get married, we buy a house, we buy a car, we have liabilities. Our partner and our family is counting on us and our income. And if we're to pass away, that's going to be a large financial impact on the family. So we want to get something that's really affordable to cover us for that period of time. But hopefully, fingers crossed, we live to, age 55, 60. Our children are now out of the house. Hopefully we paid down our mortgage. We have some investments. We're planning for retirement. The cars are paid off. And yes, if you did pass away, of course, there would be still an impact on your family, but the financial impact wouldn't be as severe. And this is the reason why term life insurance is the most popular option for most Canadians. Now let's get into the good things about term life insurance. And don't worry, we're also going to get into the bad and the ugly. And I'm going to tell you where this might not fit for you. But let's get into the good things, which is number one, which is just, like I mentioned, affordability. Term life insurance is so incredibly cheap compared to permanent life insurance. And just to give an example, term life insurance is usually, I guess I should do it the other way, whole life insurance is usually 20 to 25 times the cost of term life insurance. So if you were looking at, let's say, $1 million of coverage and it was $100 in a term policy, it would be $2,000 to $2,500 in a whole life insurance policy. So that's the first major benefit. The second one is just simplicity. It's easy to understand. There's not this cash surrender value or fund value or policy loans or collateral loans or surrender charges or MER or YRT, cost of insurance, all this stuff. There's none of that. It's just, hey, I pay my premium, I get the benefit. If I stop paying the premium, I no longer get the benefit. It's a very simple product. And the term length is also very customizable. So originally, let's say 40 or 50 years ago, you could usually only do a term 10, 20, 30 to 65 or 100. Nowadays, you have pick a term, meaning you can actually choose any term you want. It's very customizable. You can do a term 10, term 12, 15, 17, 20, 25, 30, whatever it is. Also, because it's so affordable, you don't need to have it all figured out today. And what I mean by this is you can ladder on or stack other policies as your needs change. So maybe today you need $500,000 just to cover the mortgage. Maybe you just have a partner, no children. Well, 5 years down the road, now you have children. You can keep that existing policy that you have and just add another policy for another term 20, stack it on top of that one. It's so affordable and they're so relatively inexpensive that it's very easy to customize and kind of plug and play what fits your needs as they evolve during your lifetime. However, it's not all good things about term life insurance. There are some bad things about it and some shortcomings for this product. And the first one is, this product is going to expire. It's going to end or become incredibly expensive. So with most carriers, they usually will have their term life insurance product expire at age 85, meaning if you, for some reason, kept the coverage until 85, but then at 85 you turn 86, it would essentially be canceled at that point. You would lose all the money that you put into it, and it's not meant to cover you until the very end. It is meant to be canceled, and I think that sweet spot is around that age, 60, somewhere in there, 55 to 65. After that, it gets incredibly expensive to try and maintain this product, which leads me to the second point, which is the renewals can get quite expensive. Now, remember I talked about renewals and they had to give you that renewal regardless of what happens to your health. However, that renewal is not a competitive rate. So what I mean by this is, let's say you buy a term 20 at 20 years old, meaning that at 40 years old, you're going to then have that renewal that you can have with that initial company. However, if you're still healthy and you go out onto the marketplace and get a term 20 at 40 years old at that current age, it's gonna be substantially cheaper than the renewal with that original company, because that company is pricing that renewal assuming that if you're going to use it, you are unhealthy. So the renewals can also be quite expensive depending on the carrier. Now, of course, with this temporary nature of term life insurance, this is not an ideal product for estate planning. So if you're looking for, helping to pay for taxes upon death, or leaving something behind to the next generation, or even having coverage from, let's say, 60 to 80 or 60 to 90, this is not the best product for you. And furthermore, there's also no quote unquote value within this policy. And so what I mean by that, initially, remember I said that it's not complicated, it's very simple, there is no value, which is a good thing. However, there's also no buffer within this type of policy, meaning if you miss a few payments or if you can't pay for whatever reason, it doesn't remain in force. There's nothing there to move it along down the road for maybe a few years, whereas permanent life insurance does have a few of those options depending on how it's structured. You can essentially have the fund or the cash surrender value fund the cost of the insurance for a few years if something happened. With term life insurance, there's no value in it. There's nothing in it. If you miss some payments, there's a grace period, which they'll usually give you of 30 to 60 days. However, if for whatever reason you can't pay for, let's say, 3 months to 6 months, that policy is now gone. You have to go back out onto the marketplace to apply for a new policy, and hopefully you're still in a good health condition, relatively healthy, and you're able to get a new policy at affordable rates. However, again, there's no value within the policy, and if you stop paying your premiums, it will be canceled. Which leads me to the ugly points of term life insurance. Now, there's two specific points that I'm gonna talk about. Number one is the sunk cost fallacy in the later years. And what I mean by this is, and I get this question actually quite often, and I usually get it from the children. I'll explain what I'm gonna talk about here, what I mean in a second, is let's say you have a term 20, for example, and you got it at age, let's say you got it at age 30, okay? So you had it from age 30 to age 50. At age 50, it renewed, and you decided to renew it with that company for whatever reason. Now you're paying maybe you had a health condition at 50, you couldn't go out onto the market. Now you're paying these premiums, which are quite a high premium, okay? They're significantly higher than it would be if you went out on the market and just got another policy, but you have the health conditions, so it's fine. So now you're paying these premiums at age 50, you get to 55, you get to 60, and you can see that your health is declining. And now you start to run the numbers and you think, hey, am I gonna live till 70? The premiums are quite a bit though. They're like $800 a month at this point. I'm just throwing a number out there for you. But you're thinking, yeah, they're $800 a month, but the death benefit is $1 million. So all I need to do is pass away before, age, let's say 75, and it'll be worth it. And I've had a lot of conversations with the children because what will happen is the parents will go to the children and say, hey, I have this policy. It's $800 a month. I'm having trouble affording it. I don't think I'm going to live very long. If you pay for it, you can have the benefit. Here's my opinion on this, and here's what I think is a problem, of this type of strategy or this type of, thinking, I guess I'll say, is that if you do this with the children are now turning their parents into a financial transaction. And the more that they pay, the more that they now get caught in this sunk cost fallacy where they think, I've already put in now $2,000, now $5,000, now $10,000, whatever the number is. And they're thinking, I'm stuck now. I have to keep paying for this term life insurance policy until I die to recoup my money. Well, what's the problem with that? What happens all of a sudden if your parents get healthy? What happens if they, start taking care of themselves? Maybe they didn't eat right or exercise, and then they start doing it. Well, now you as the child, or even as the parent, if you're still paying for it, you're de-incentivized to be healthy. From a financial point of view, it's better for you to die sooner than it is for you to be healthy and live longer. And especially with the children, I recommend unequivocally against this. I say do not do this, because now think about it. Everything that happens to your parents from a health point of view becomes a financial transaction. They go to the hospital, wow, you're kind of sad about it, but also, hey, sweet, this would be an ROR of, let's say 350% if they died tomorrow. Like, that's just not a place that I want to be in personally with my parents. And I think most people would agree that they don't want to be there as well. So this is one of the ugly things about it. If you do have a term life insurance policy in your 50s and 60s, and you do see your health declining, you can get caught in this sunk cost fallacy where you think, maybe I should just stick it out until I die because that may be soon. You're right, it may be soon, but also it could be a long time away and you've wasted all your money. And the more that you put into it, the more you're going to feel attached to continue those payments until you pass away. And the last ugly thing here that I'll talk about with term life insurance is misrepresentation. Now, if you follow my channel or if you've seen any of my videos, you'll know that I firmly believe in term life insurance, and I believe it is the best option for the majority of Canadians. However, it's unequivocally undeniable that for a certain group of individuals, it can be very beneficial for different types of permanent life insurance, whether it's personally owned, corporately owned as well. There's some major advantages to having whole life insurance or universal life insurance. And the problem is when either advisors on the insurance space or investment advisors will blindly preach, buy term, invest the difference, no matter what, that's what you should do. One of the agencies that does this quite often is Primerica. I believe in that most of the time. However, again, it's undeniable that there are specific circumstances where permanent life insurance is a better option for those individuals. And usually it is those high income earners that have already maxed out other traditional accounts or business owners with unique tax problems that need to be solved upon death. So who do I think should consider term life insurance? Well, again, I've said this, again and again, I think it's best for those families, those individuals that are looking to cover themselves for a specific period of time. Maybe that's business owners that are in business together and they want to get a buy-sell agreement. It's families that have children, mortgages and loans and outstanding payments that they want to cover. Anyone that needs to have a specific period of time covered at the most affordable rate and then canceled at the end, term life insurance is going to be the best product for you. Like I said at the beginning of this video, I believe term life insurance is the best product for the majority of Canadians. However, you can see there are some limitations, and for very specific individuals, permanent life insurance could be a good option. So with all that being said, I hope that you guys enjoyed today's video. If you guys have any questions or comments, just drop that below. And as always, if you guys are enjoying this content, all I ask is you give it a thumbs up, and I'll see you guys in the next one.